the allure of precious metals like gold and silver has stood the test of time, especially for investors seeking stability in a turbulent market. These glittering assets have long been preferred as safe havens, whether as an alternative to the unpredictable stock market or as a shield against inflation and economic changes. But when it comes to choosing between gold and silver, which one is better as an investment? The answer is not as simple as it sounds. It depends on your financial goals, the amount you want to invest, and of course, your willingness to take risks. So, which metal will be best suited for your portfolio? It depends on the kind of investor you are. Before investing, many questions will come to our mind, which can be as follows. 1. How do gold and silver stack up against the stock market? 2. Does Warren Buffett invest in gold or silver? 3. How much should I allocate to gold or silver investments? 4. Where is the best place to purchase silver or gold? 5. Are gold and silver solid long-term investment options? 6. What are the steps to buying gold? 7. What is the current price of gold? 8. How can I buy physical gold? 9. Where can I buy gold? 10. What key factors should I consider when buying physical gold? 11. What makes gold so valuable? We will discuss the answers to these questions further, which will help us to become wise and successful investors. So let's move ahead, continuing with these topics. Gold or silver, key factors to consider before investing in precious metals. Investing in precious metals like gold and silver can be a smart way to diversify your portfolio, but not all that glitters is gold, literally. Before you dive into these shimmering assets, it's crucial to weigh some key factors that can help guide your decision-making. 1. Uses. Beyond just jewelry, gold and silver may sparkle in jewelry stores, but their roles in the global market stretch far beyond adornments. Gold's primary use is in jewelry and as a hedge against inflation, while silver takes on a broader spectrum of industrial applications. Silver, for instance, plays a key role in the tech world. It's a vital component in electronics, solar panels, and even smartphones. This means when industries boom, silver's demand spikes, potentially making it a solid option in a thriving economy. In 2023, while demand for silver in jewelry and silverware dipped, its industrial use, especially in electronics, remained strong, indicating its dynamic role in modern manufacturing. Gold, however, is traditionally more of a safe haven investment, often preferred by those looking for long-term security in volatile markets. 2. Price, the entry point for every investor. One of the clearest distinctions between gold and silver is the price. As of May 2024, gold is trading at a hefty $2,422 per ounce, while silver is far more affordable at just $32 per ounce. This price disparity makes silver an attractive option for beginner investors or those working with a smaller budget. If you're planning to own physical bullion, silver's lower price offers a more accessible entry point. You can amass a larger stockpile of silver for less upfront cost than gold, which can make a difference in certain strategies. Top 3. Volatility, the bumpy road to profit. The value of gold tends to be more stable, making it a go-to during times of economic downturn. Brighten your portfolio. Smart ways to invest in gold and silver beyond bars and coins. Looking to add a little luster to your investment portfolio? Gold and silver offer unique options that go beyond traditional stocks and bonds. Here are a few smart ways to invest in these precious metals without needing to stash bars and coins in your basement. 1. Buy physical gold or silver. Investing directly in physical gold or silver, like gold bars or silver coins, gives you tangible assets with real intrinsic value. This approach can be appealing if you enjoy the idea of holding a physical representation of your wealth. However, storage and insurance are considerations, so make sure you have a plan for safeguarding your metals. 2. Invest in gold or silver ETFs and mutual funds. For a more hands-off approach, consider mutual funds or exchange-traded funds, ETFs, that track precious metals. These funds mimic the ups and downs of gold or silver prices without you needing to store the metals. For example, the iShares Gold Trust, IAU, aligns with daily gold price movements, while funds like the Franklin Gold and Precious Metals Fund, FKRCX, invest in companies engaged in gold and metal production. This lets you benefit from price fluctuations without the logistics of physical storage. 3. Invest in precious metal industries. You can also tap into the value of gold and silver by investing in the industries behind them, such as mining. Companies like Newmont Mining, NEM, and Barrick Gold Corporation Gold are major players in the precious metals sector, offering exposure to gold and silver through stock ownership. These companies' shares often respond to shifts in metal prices, so you can gain indirect exposure while investing in a larger corporate entity. By exploring these options, you can invest in gold and silver in ways that best fit your goals and lifestyle, adding a timeless hedge to your portfolio. Should you invest in precious metals? Let's weigh the glitter and the gold. The allure of gold and silver is more than just their sparkle. These precious metals have captivated investors for centuries. Unlike other assets, they hold a unique, tangible value that tends to shine brightest when economic uncertainty looms. Gold especially has proven itself a steady hand during market fluctuations, maintaining value even as other investments falter. This stability can offer a certain peace of mind, making gold and silver popular choices for those looking to hedge against financial turbulence. But is the metal as good as gold in every portfolio? Maybe not. For the long-term investor focused on growth, a well-diversified portfolio of stocks, bonds, mutual funds, or ETFs may provide better returns. Stocks offer growth potential, bonds bring stability, and a diversified mix can maximize your chances for long-term success. Precious metals, on the other hand, don't generate dividends or interest and can lack the growth potential that stocks and other assets offer over time. Before making any decisions, consider your financial goals and risk tolerance. Investing isn't just about what's appealing today, it's about where you want to be tomorrow. How to invest in gold, unlocking the gleam of history's most resilient asset. Few investments have carried as much historical weight as gold. It has long been seen as a hedge against economic chaos, inflation, currency fluctuations, and even war. But when it comes to investing in gold today, there's a treasure trove of possibilities beyond just stockpiling shiny coins or hefty bullion. Modern gold investment is as versatile as it is valuable. Alongside the classic route of buying physical gold, you can also gain exposure to the golden metal through shares in mining companies, exchange-traded funds, ETFs, and even by trading options or futures contracts. Let's dive into the ways you can invest in gold and uncover which option might just strike it rich for you. 1. Investing in physical gold. Owning physical gold is a timeless approach, but it requires more than just the ability to pay for it. You'll need to navigate the world of reputable dealers, consider how and where to store your precious metal, and maybe even insure your haul. Here are the most common options. Gold bullion, the gold standard. When you picture gold, you probably imagine gleaming bars tucked safely away in a vault. That's gold bullion. These bars come in various sizes, from a few grams to a whopping 400 ounces. The typical gold investor, however, deals in smaller 1 or 10-ounce bars. With gold prices hovering around $1,900 per ounce as of September 2020, gold bullion is far from a budget-friendly investment. And unlike stocks, you can't buy fractional pieces, so be ready to go big or go home. This makes it crucial to buy from a trusted dealer and arrange secure storage, either in a vault or safe deposit box. Gold coins, portable and iconic. Gold coins are a more accessible and flexible way to own gold. Popular coins like the American Gold Eagle, Canadian Maple Leaf, or South African Krugerrand are available in weights as small as a quarter ounce, making them easier to trade and store than bullion bars. However, collectible coins often trade at a premium over their gold content. For instance, a 1-ounce American Gold Eagle might sell for just over $2,000, which is about 5% more than the value of an equivalent amount of bullion. So while coins offer a portable form of wealth, it's important to factor in any markup. Gold jewelry, wear your investment. Why lock your gold away when you can wear it? Gold jewelry, whether brand new or vintage, offers another way to invest. But beware, jewelry carries additional risks. From authenticity concerns to designer markups, buying gold jewelry as an investment requires caution. The higher the purity, 24 carats is 100% gold, the more valuable your piece, though gold of lower purity will be less expensive. While you might find investment-worthy jewelry, it's crucial to work with a trusted dealer and know exactly what you're buying. Factors to consider when buying physical gold, a guide for the savvy investor. Investing in physical gold can be a rewarding venture, but it comes with its own set of considerations. Here are the key factors to keep in mind to ensure your investment is secure, valuable, and set up for long-term success. Hash 1. Storage. Finding the right home for your gold. Unlike stocks or bonds, physical gold requires a secure, tangible place to live, while keeping it at home may be tempting. Remember that a dedicated, secure storage option often offers more protection. Many investors choose custodial services for added security. Before you buy, research trusted storage options and bear in mind that safe storage typically adds to the overall cost of your investment. Whether at home or through a third party, ensuring your gold's safety is essential. 2. Insurance. Safeguarding against the unexpected. If you opt to store your gold at home, consider insuring it as an extra measure against theft, natural disasters, or other unforeseen events. Adding gold to a homeowner's or renter's insurance policy might raise your premiums, but offers peace of mind. Even if you choose off-site storage, look into your provider's insurance policy. You'll want to know precisely how your gold is being protected in the event of loss or damage. HAR 3. Manufacturer. Quality and reputation matter. When it comes to gold, the producer's reputation can significantly affect the long-term value of your investment. Reputable mints and manufacturers like Credit Suisse, the Perth Mint, and the Royal Canadian Mint are known for high-quality, authentic products. Buying from trusted sources not only ensures you get what you pay for, but also helps your gold retain its value over time. HABA 4. Purity, the key to investment-grade gold. Gold purity is a critical factor in its value as an investment. Most serious investors seek gold items with a purity level of at least 91% and ideally 99% to ensure they're getting investment-grade metal. Higher purity levels generally translate to better value retention and make it easier to sell in the future. In summary, buying physical gold involves more than just making a purchase. It's about planning for security, quality, and long-term value. By considering these factors, storage, insurance, manufacturer, and purity, you'll be well on your way to building a solid gold portfolio that can stand the test of time. If you're thinking about getting into gold, you don't have to go through the hassle of buying and storing physical gold bars or coins. Instead, you can take a more convenient route by investing in the stocks of gold mining companies. It's as simple as using your regular brokerage account to buy shares in companies that dig for, refine, and trade this precious metal. Here are a few of the biggest players in the gold mining world that you can invest in. Newmont Corp. Based in Colorado, Newmont is the world's largest gold miner, with operations spanning North and South America, as well as Africa. Barrick Gold Corp. A major gold producer headquartered in Toronto, Barrick operates in 13 countries globally. Franco-Nevada Corp. FNV. Unlike traditional miners, Franco-Nevada focuses on earning royalties from other companies' gold production without owning any mines itself. Investing in these companies gives you exposure to gold's performance. But keep in mind, their stock prices don't move purely in sync with gold prices. These stocks are also affected by factors like profitability, operational costs, and market conditions unique to each business. So, while you're banking on gold, you're also subject to the usual ups and downs that come with investing in individual stocks. If you're not careful, the volatility of single stocks can be a wild ride compared to the steady diversification of funds. Looking to add a little sparkle to your investment portfolio? Gold ETFs and mutual funds might be the perfect way to tap into the timeless appeal of gold without the hassle of storing bars or coins. They offer a clever way to benefit from gold's reputation as a stable, long-term asset while giving you the flexibility and diversification that physical gold lacks. Here's how it works. Gold ETFs, exchange-traded funds, and mutual funds are essentially paper investments that give you indirect exposure to gold. Instead of owning the actual metal, you own shares of a fund that may hold gold bullion, track gold prices, or invest in companies involved in gold mining and production. For instance, the SPDR Gold Shares ETF, GLD, holds physical gold and its value mirrors the price of bullion. If you're looking for a broader slice of the gold industry, the VanEck Vectors Gold Miners ETF, GDX, could be your go-to. This ETF doesn't hold gold itself, but tracks the performance of major gold mining companies. If you prefer a more hands-on approach to your investment, gold mutual funds like Franklin Templeton's Gold and Precious Metals Fund are actively managed by professionals who aim to outperform the market. While they may come with higher fees, the upside is potential outperformance compared to passively managed funds. But keep in mind, owning shares in these funds doesn't mean you own physical gold. You're holding assets tied to the performance of mining companies or the future price of gold through options and contracts. This means the value of your investment might not perfectly align with the actual price of gold, so it won't always move in sync with the bullion market. In a nutshell, gold ETFs and mutual funds are a savvy way to get involved in the gold game without needing a vault. Just be aware that their value is linked to more than just the shiny stuff. It's also tied to the companies and markets that deal in gold. So, while they bring convenience and diversity, they may not be the same as holding the real deal. Gold investing with futures and options, high risk, high reward. If you're looking to dive into the world of gold investing, trading futures and options contracts is one of the more adventurous routes. It's a speculative strategy best suited for those comfortable with risk and ready to monitor their investments closely. What are futures and options? These are both derivatives, meaning their value is tied to the price of an underlying asset. Here, that asset is gold. But how do they differ? Futures contracts lock you into an agreement to buy or sell gold at a predetermined price on a future date, no matter what happens to gold prices in the meantime. This is a firm commitment. You're either buying or selling on that set date, regardless of the market conditions. Options contracts, on the other hand, give you a bit more flexibility. You're not forced to buy or sell. Instead, you have the option to do so if gold hits a specific price by a certain date. It's like having a maybe button on your gold investment strategy. How to get started? First, you'll need an account with an online broker that offers futures or options trading. Not all brokerages allow it, so finding one that does is your first step. Keep in mind though, trading derivatives like these usually involves signing additional risk disclosure forms. Because the stakes are high, you're acknowledging that you understand the potential for both profit and loss. Once your account is set up, you can trade directly on your platform, but there's usually a commission fee for each transaction. This fee depends on how many contracts you're buying or selling, so it's smart to keep an eye on those costs. Why futures and options require constant attention? Unlike buying physical gold or shares in a gold mining company, futures and options aren't something you can simply stash away and forget about. These contracts come with expiration dates, and you'll need to make decisions before those dates hit. You can sell the contracts, roll them over to a new contract, exercise the options, if applicable, to lock in your price. But here's the kicker. These contracts typically involve leverage. That means you're borrowing money to increase your position size. Leverage can amplify your gains, but it also means that losses can pile up just as quickly if the market moves against you. For those not careful, this can turn into a financial spiral. Is it right for you? Investing in gold through futures and options is not for the faint of heart. It demands regular attention, a good understanding of the market, and the willingness to take on risk. However, for those who thrive in fast-paced, high-stakes environments, it could be a rewarding way to invest in the world's most treasured precious metal. If you're ready to take on the challenge, futures and options can be a thrilling way to capitalize on gold's price movements, but always be prepared for the ups and downs that come with it. Investing wisely starts with choosing the right online broker, a decision that can shape your entire financial journey. Today, the sheer number of platforms offering free stock trades and zero commissions on various assets can make this choice feel like navigating a maze. With so many options, how do you find the one that truly fits your needs? That's where Expert Advisor steps in. we've taken a deep dive into top online brokers to spotlight the best of the best. Our curated list highlights platforms for every type of investor, whether you're a hands-on trader or someone just starting to build their portfolio. Gold has captivated human hearts and imaginations for thousands of years, shimmering as both a symbol of power and a cornerstone of economic stability. Picture an ancient marketplace bustling with traders, their carts brimming with spices, silk, and exotic wares. Among these treasures, the most mesmerizing is a gleaming metal, soft, untarnished, and rare. That's gold, the metal of kings, highly prized even in the earliest civilizations. But why did gold stand out over other metals? It all began with gold's unique qualities. Unlike other metals that corrode or lose their luster over time, gold remains eternally radiant. This durability, combined with a warm, glowing hue, made it ideal for creating jewelry, crowns, and sacred objects, symbolizing purity and prestige. Beyond beauty, gold's scarcity was key. In a world where finding gold was a rare feat, it became a mark of distinction and wealth. Its worth was not just in what it could buy, but in its almost magical, untouchable quality, untarnished by time. Though the US and many other countries abandoned the gold standard in the 1970s, the appeal of gold as a valuable asset has only grown stronger. People still treasure gold, whether as jewelry, coins, or bars, trusting it as a stable store of value amid the ups and downs of paper currencies. Gold isn't just pretty, it's a hedge against uncertainty, a kind of insurance against the volatility of fiat money. And so, gold endures. From the bustling bazaars of ancient Egypt to the modern-day financial markets, gold has held onto its value across centuries, empires, and economies. It's a reminder that sometimes, in a world that constantly changes, value can be found in the things that stay beautifully the same. Brighten your portfolio. Smart ways to invest in gold and silver beyond bars and coins. Looking to add a little luster to your investment portfolio? Gold and silver offer unique options that go beyond traditional stocks and bonds. Here are a few smart ways to invest in these precious metals without needing to stash bars and coins in your basement. 1. Buy physical gold or silver. Investing directly in physical gold or silver, like gold bars or silver coins, gives you tangible assets with real intrinsic value. This approach can be appealing if you enjoy the idea of holding a physical representation of your wealth. However, storage and insurance are considerations, so make sure you have a plan for safeguarding your metals. 2. Invest in gold or silver ETFs and mutual funds. For a more hands-off approach, consider mutual funds or exchange-traded funds, ETFs, that track precious metals. These funds mimic the ups and downs of gold or silver prices without you needing to store the metals. For example, the iShares Gold Trust, IAU, aligns with daily gold price movements, while funds like the Franklin Gold and Precious Metals Fund, FKRCX, invest in companies engaged in gold and metal production. This lets you benefit from price fluctuations without the logistics of physical storage. 3. Invest in precious metal industries. You can also tap into the value of gold and silver by investing in the industries behind them, such as mining. Companies like Newmont Mining, NEM, and Barrick Gold Corporation, Gold, are major players in the precious metals sector, offering exposure to gold and silver through stock ownership. These companies' shares often respond to shifts in metal prices, so you can gain indirect exposure while investing in a larger corporate entity. By exploring these options, you can invest in gold and silver in ways that best fit your goals and lifestyle, adding a timeless hedge to your portfolio. Buffett's philosophy on investment. Warren Buffett, one of the world's most successful investors, has a clear investment philosophy. He believes that investing in productive assets, like stocks, provides better long-term value than holding non-productive assets. Why Buffett avoids gold and silver? Gold and silver are often seen as safe haven investments. People buy them when they're worried about the economy because they hold value over time. However, Buffett argues that these assets don't actually produce anything. For example, if you own a gold bar, it won't generate cash flow, create new products, or pay dividends. Preference for stocks. Buffett prefers stocks because they represent ownership in a company. If you own stock in a company, you own a part of that company's future profits, and those profits can grow over time. Stocks, therefore, have the potential to increase in value as the companies grow, make more money, and innovate. Buffett's advice on long-term investing. He encourages investors to look at the long-term growth of businesses. While gold and silver may retain value, stocks have historically shown greater growth over long periods. By investing in strong businesses, he believes people can build more wealth over time. Avoiding speculation. Lastly, Buffett is known for avoiding speculative assets, like cryptocurrency, which he believes don't have intrinsic value. His view is that these assets rely too heavily on people guessing or betting on future demand rather than on actual business performance. In summary, Buffett doesn't invest in gold or silver because they don't generate profits or create value. Instead, he champions investing in productive assets, like stocks, where long-term growth potential aligns with his investment strategy. Why are gold and silver considered long-term investments? Gold and silver, along with other precious metals, are often chosen by investors who want to preserve the value of their assets over time. This is because these metals tend to hold their value, especially during economic uncertainty. People buy gold and silver not necessarily to make quick profits, but to protect their wealth from inflation or currency devaluation. In other words, they provide a kind of insurance for wealth. The difference in volatility between gold and silver. While both metals are valuable, silver is usually more volatile than gold. This means that its price can fluctuate more widely in the short term. This is because silver has both industrial uses, like in electronics, and investment demand, which can cause its price to rise and fall more quickly in response to economic changes. Gold, on the other hand, is often viewed as a more stable store of value and doesn't experience as much day-to-day price movement. Gold as a tool for preservation. Gold is often seen as a safe haven investment because it has held value over centuries. When other assets, like stocks or real estate, may lose value, gold tends to be more stable, making it a valuable option for long-term wealth preservation. Is gold or silver a good long-term choice? Generally, if your goal is to maintain the value of your assets over the long run and hedge against inflation or currency risks, both gold and silver can be beneficial. However, understanding the differences in their behavior, like silver's volatility and gold's stability, can help you make a decision that aligns with your financial goals.